Very recently, I have just turned this $100 into $1 million over the course of 90 days. And you want to know what surprised you guys the most? It definitely wasn't when I was about 2 weeks away of making the $1 million by taking 100K into 300 and 300K into $1 million. It's actually when I turned these $100 into $3,000. It's the most viewed and the most watched series every single time I do the challenge. And you know what? That needs me to understand that you guys are trying it and trying to take the challenge on for yourself, which I'm absolutely flattered and I love it. And that is the reason for this video today. I'm going to give you the tips and tricks on how I turned $100 into $3,000 in the challenge, and how you can turn a small account from 50 to 100 bucks to maybe 500, 1,000, or even a couple of $1,000s in just 30 days. And now, before I start, I want to leave something extremely clear. Flipping accounts or growing small accounts is not going to make you profitable. Just because you can take $50 into 500 or $100 into 1,000, that does not mean that you are a profitable trader. That just means that you know how to scale an account aggressively and quickly. But to become a profitable trader, you have to learn how to properly manage money and consistently make profits month after month. Flipping accounts and growing small accounts is not the way to become a constantly profitable trader. This is something that intermediate and advanced traders do on their free time to just make trading a bit more exciting. Because once you're profitable, trust me, trading gets very, very boring. So to clarify, I do not recommend flipping accounts if you are a beginner or if you want to make this type of trading your main source of income. Flipping is definitely not the way. It's more of the fun way to bring some spice into the action of the trading world. And secondly, which is probably one of the most important things if you want to get into this flipping game and growing small accounts, is you have to have the new fisherman mindset. Now you're probably asking, what the hell does that mean? Well, let's say it's your first time going out to fish. It's your first time buying a new rod, putting on a hook, putting on the bait into the hook. Your first time that you get a rod, your hook, and the bait and you cast it, it's probably not the first time you're going to catch the fish. You're probably not even fishing at the right spot. The bait comes off the hook, maybe a fish grabs on, but you didn't tie the hook on good enough. There's multiple mistakes that you can make, but it's very easy for you to grab on and fix to it. The same thing is going to happen to you if it's your first time growing a small account. You might maybe be trading the right market, or you might not be trading at the right time, or you don't have the right entry signal, and you might just lose the account. And I need you to be on the fisherman mindset, because just because the first time you cast out the bait and you don't catch a fish, you're not going to just leave and never try it ever again. You're going to simply reel back in your hook, put out another bait, and try it again. It's the exact same thing when you're growing a small account. If the first time you end up blowing your account, which is small amounts of money and should not be significant to you, you just simply try it again, because it's a small account that you're trying to go. If you're not trying to make a living off of this, just doing this for fun and giving a little spice into trading. This is very key to the longevity of you growing a small account, because you're not emotionally attached to the money and you're just doing this to bring some spice into it. You're not doing it to make money. You're doing it to have fun, and then obviously in turn you will make money. So now that we understand that, let's go into step number one, which is truthfully the most important step. And if you do this correctly, you're already ahead of the game of 99% of traders that are going to try and grow and scale a small account. And I'm going to be very straightforward and very simple with this rule, and it is as simple as it gets. Do not overcomplicate it. Do not try to find a different way around it. It's this and it's this. There's nothing around it. Step number one is going to be to find the best possible trade to be your first trade. There's no way around it. You need your first trade to give you the best entry, the minimum drawdown, and the maximum risk to reward. You're literally growing a small account. The hardest part is getting out of the hole, getting out from that small $50 balance or a $100 balance to then scale it to a couple hundred or thousands of dollars. You need to find the perfect trade. It might not happen the same week you deposit into your account. It might not even happen the next week. So you have to be patient waiting for that right trade. Do not settle for any trade that is nothing under perfect, because you need the trade to be able to give you the maximum amount of profits, so then you can leverage the profits that you make on your account to then scale without having to risk all of your money. But if the first trade that you take is going to be a trade that is 50-50 and you're not sure about it, do not execute that trade. Wait for the best possible trade scenario. Again, you're not making a living off of this. You're not doing this for the money. You're doing this for fun to spice up your trading a little bit. So waiting for that right trade is going to be key to growing your small account and getting you out of the hole. It can take 4 days, it can take 1 day, it can take a week. But I want you, before you click the buy or the sell button, when you're going to execute your first trade, I want you to ask yourself, is this the best possible trade that I could be taking at this very moment? If the answer is no, then wait for another trade. If the answer is yes, double check and then execute the trade on that very best trade that you have just found and you have been waiting for. And when I mean double check the reasons on why you're entering the trade. Are you entering the trade because all of your confluences have been met? Are you entering the trade at the right trading session? Do you have your entry signal? Do you have positive risk to reward? Am I taking an impulsive trade, or is this a real trade that meets my strategy? Because at the moment of you being in front of the market, you might be seeing things that you shouldn't be seeing because you just want to execute the trade right away and be involved into the market. But if right before you click that buy or sell button, you double check everything, which almost gives you a different reality check and a different perspective on the market, you decide, you know what? Yeah, it does make sense. Or you know what? No, I'm making an impulsive decision. So double checking is always key when it comes to taking your first trade on growing your small account. Step number 2 on growing your small account, which is basically as important as the first step, is going to be holding your trade. I cannot stress to you how many of you guys will select the first trade, the best possible trade possible. But when you have just made a little bit of money on your account, you close it. You cut your profits so fast and you are literally defeating the whole purpose of waiting for the best possible trade. When you wait for the best possible trade that meets your checklist and meets your trading plan, it is literally for you to maximize those profits. Don't rest for a 1-to-1 risk to reward or even a 1-to-2 risk to reward. Aim for the 1-to-3, 1-to-4, 1-to-5. This is what waiting for the best possible trade is the outcome of maximizing your profits and minimizing your losses. You want to make sure that you can hold as long as you possibly can, because once you risk your account on your first trade, you want to make sure you can maximize it as much as you can. So when you close out at the max profits you have, you do not have to then risk all of that money again on the next trade. So you want to maximize your profits so then you have more money into the account that won't overexpose you and take you back to the next step. And maximizing your profits is really different depending on the type of trade that you're doing. If you're taking a day trade, you should be looking for a 1-to-4 to a 1-to-5 to a 1-to-6. If you're swing trading, you should be aiming for a 1-to-5, 1-to-6, 1-to-7 risk to reward. You want to make sure that you can maximize the most amount of profit out of the trade that you're taking. Now, keep in mind, if you're taking a scalp trade, can't really expect to have a 1-to-7 risk to reward just because of the nature of the market does not end up giving you those type of moves. So depending on the type of trade that you're taking, make sure you can maximize the amount of risk to reward that you're going to be having inside of that strategy. Now, we all have different strategies and we all have different ways on looking the markets. And I'm going to explain to you next on how I do it, but you got to make sure that you are familiar with the type of trade that you're taking so you know how to then maximize the profits there. And another little hack that I have for you guys to maximize your profits is going to be to always close your trades at the end of New York session. And you might be wondering why. Well, at the end of New York session is literally at the end of all the push the market has had. And that's where you're going to maximize your profits. Because if you enter a trade in London and then you hold throughout London, and let's say you close at the end of London, beginning of New York, there is a whole new volume. And if you have the right direction of the market, then that session is going to continue to push the trade into your favor. How many times have you closed a trade and as soon as you close it, the trade keeps going into your take profit and then you miss out on all those profits? That sucks. It happened to me and I hate it. And the way I've learned to maximize the profits is by waiting into the end of the day on New York session to close out on the trade, because that is when all the move is done and you're able to close out at the final trade that the market has done. And step 3 is probably the hardest one, which is going to be repeated. All you literally have to do is repeat step number 1 and step number 2. That is literally what I did over the course of 3 months, turning $100 into $1 million. Now, it's very hard to obviously wait for those perfect trades, and I know it's very hard to then hold them as much as you can, but it's even harder for then you to be patient to wait for those next trades. But I promise you that as soon as you enter into that flow and you enter into that mindset and you start normalizing taking these type of trades only, then you're going to see how much your small account is going to grow so much faster exponentially, because you're simply taking the highest probability trade possibles. And the highest probability trade possibles, the way I do it and the way I analyze it, are going to be off of 3 basic foundations. And I do this for every single one of my trades on my personal accounts, on my growing accounts, on my flipping the 100 into the mill. These 3 things are exactly what I did. You can go see it for yourself in the 100 to the mill series that I have done. Step number 1, and the most important, is going to be 2 consecutive time frames in sync. For example, if you want to buy the market, you want to have the weekly and the daily in your favor that are bullish. If the weekly and the weekly is bullish, the daily is bearish, and the 4-hour is bullish, you have 3 markets that are all over the place. There's no consecutive time frames. You should not be interested in the trade. You should only be interested in the trade if you have either the weekly bullish, the daily bullish, and let's say the 4 hours bearish. That's fine, because you have 2 consecutive time frames in sync to the upside and then you buy. Or let's say you have the weekly bearish, but the daily bullish and the 4-hour bullish. This is good because you have 2 consecutive time frames in sync heading in the direction that you would want to. Now, obviously the same thing would happen if you were selling. If you have the weekly bullish, but then the daily and the 4-hour are bearish, that's fine, because you have 2 consecutive time frames in the same direction to then sell. Having the consecutive time frames is you trading with the trend. So we've all heard the term, the trend is your friend, and trust me, it is. So for example, you can take Euro JPY, where I started off the week saying that I wanted to make $250,000 by the end of the week. And I did, because I literally waited for the market to give me the 2 consecutive time frames in sync. This is going to be key for you guys to understand that you don't always have to wait for 3 time frames, but you need to have a minimum of 2. And in this case, we ended up holding the trade for about 3 days, and we got about a 1 to 2.5 risk to reward, where we made $250,000. You don't always have to wait for 3 time frames in sync. 2 time frames is more than enough, but 2 time frames is not enough to just execute the trade. You're going to need the next point, which is going to be area of interest. Where are you going to be entering the trade in this market that's bullish or in this market that's bearish? If the market is bullish, you need to find a key level to then buy. If the market is bearish, you need to find a key level to then sell. Just because the market's bullish, you can't just buy because the market's going up, or if the market's going down, you can't just sell because the market's going down. You have to wait for a very precise pullback into a specific zone, where then there you're going to apply the next step. But the area of interest is even as important as the trend, because if you don't have price pull back into this area, you do not execute the trade. The best analogy that I can put to this is when you are going to, let's say, buy an investment. Let's say you're going to buy a real estate investment. You don't ever want to buy at the high of the market. Let's say you're going to buy a property for $100,000, and that is the maximum that the home is valued at in that neighborhood. That's not a great investment. You want to wait for the property to have some type of time in the market, so then you have room for negotiation and you can make an offer for, let's say, $80,000. And then if you were to make an offer for $80,000 after 2 months of it being on the market and nobody else has bought it, and you make the offer for 80 and they accept it, visually on the chart, what you see is price go up to 100,000, then retrace to 80. That's where you buy, and then you hold for the next year or 2, and then the price continues to go up. You're waiting for the discount on the real estate. It's the exact same thing on the market. When the market is bullish, you're waiting for the pullback. That is the discount that you're going to be waiting for the market. So then you execute the trade and then you buy. So on this discount that you're waiting for the market, as soon as you start seeing that retracement and it's going into the area of interest, you then need the reason on why you're going to enter. So it's going to be known as the entry signal. Now in trading, there's many different types of entry signals, but the ones that I use are going to be the most important to me in my strategy and the most powerful that I have seen over the last course of 7 years of trading the market. First one is going to be morning star formation and the evening star formation. And now the key of these two patterns is that it happens at the area of interest, not almost at the area of interest or away from the area of interest, is at the area of interest. Once price has made it to the area of where it's the perfect discount, then you have the entry signal there, then you take the trade. You do not take the trade, even if you have the entry signal, if it's not at the area of interest. This is going to be very key for you to avoid wick outs, fake outs, liquidity grabs, all these different type of excuses that traders put into the market on why they got stopped out. I barely ever get wicked out or stopped out because I wait for the trade to make it to the area of interest. And the best analogy that I can put on these entry signals, it's as if you are interested in buying this home for 100,000, price is starting to retrace and have a pullback and get a discount at 80,000. And the reason for you to enter that investment is that a home 5 doors down just sold for 95,000. And that current house you're looking to invest into is still priced at 80. That is your entry signal, meaning if you buy this property, the comparables around you are going up, which makes it a great investment. This is very similar in the markets, but you're gonna have that entry signal or that confirmation of the next property being sold at a higher price when you have these entry signal confirmations. But again, the most important thing is that you have the entry signal at the area of interest. And lastly is going to be the risk management. Risk management is key to this because obviously you're growing a small account. You need to obviously have a proper risk management. And truthfully, let's be honest, there's no real risk management here. There's no real 1%, 2%. You're never gonna grow a small account like this. You're not gonna risk 1% of $100. You're not gonna risk $1. Respectfully, it just won't make sense of your time, and it's not going to be worth your headspace and the efforts you're gonna put into the market. The first trade you're gonna take has to be 100% risk of the account. If you are not okay with risking $100, then you are not ready to grow a small account. This is meant for people that are okay with risking $100 and it does not affect them financially and it's not a financial burden into their statements. This is going to be just for the first trade. You're gonna risk 100%, maximize your profits, and then on the following trades, you're then going to be risking anywhere from 30 to then 50%. If you win the next trade and then you get a 1 to 3, 1 to 4, then every trade after that, you're going to risk 20 to 25%, but no more than 20 to 25%. This is going to be very key to then successfully staying positive on the account. Because if you were to say, let's say you start off with $100, then you take it to about 400 to 500, then you risk 50% of that. So then you're risking $200, and you got another 1 to 3. Now you have just turned the account balance of 400 into about 1,000. And then you can just risk 20% of that, which you're risking $200 per trade. This is very key by simply risking 100% on the first trade, 50% on the second, and then 20 to 25 on the third, and so on. And most importantly is to have a take profit of your account. My goal is to take this $100 into 500, or take this 100 into 1,000 or 4,000, 5,000, whatever goal it is that you want to take, be realistic to it. And once you get there, withdraw the money and do it again. Do not get greedy. Do not want to try to make more money than you should. Stay to the plan and do not break it for anything. Getting greedy in the markets will mess up everything that you've done. And these take profits are things that I do every single week for my personal account. Literally on this Euro JPY trade, I start off the week saying, you know what? I want to make $250,000 for the week. The trade hit exactly $251,000. And I could have gotten a lot more profit, but that's all that I wanted for the week. These are things that I constantly do with my students every single Sunday when I break down the exact same trades that I'm taking, where I'm going to be making profits like these and profits like these. I literally share with them every single Sunday on a call that we get called Sunday Swings, where I break down every single trade on what I'm looking to do, where I'm looking to enter, and where I'm looking to get out. They have access to my full strategy and part of the private Discord community. If you want to learn more about the Set and Forget strategy and how it's made me hundreds of thousands of dollars, make sure you guys check out the link in the description below, because it's where I'm going to be getting on weekly calls with my students, sharing my trades. Hope you guys hit that like and subscribe button, and we'll see you guys in the next one.